Elon Musk is on top of the world. The entrepreneur made $1.1 billion this week, according to the Bloomberg Billionaires Index, as shares of Tesla gained 16% on higher sales forecasts and plans for its Gigafactory. And Musk isn't just driving its own stock higher. Eric Balchunas is here with 3 ETFs the billionaire might be bringing higher. And a lot of them have to do with alternative energy, not to do with autos, but with alternative energy.
Yeah, no shocker. And, you know, first of all, if you're looking at ETFs, the big plain vanilla ones, they don't really have any exposure to Elon Musk companies at all. So you got to go to the niche area. One example of that is the Market Vectors Global Alternative Energy. Okay, this one's a pretty small ETF, but it's got 18% exposure to Elon Musk companies. 14% is Tesla, 4% is Solar City. And what's interesting about this ETF, it's up about 12% year to date. Of that 12%, Elon Musk is personally responsible for about 8.5%. So it's rare to see one person have such an effect on an ETF that holds 30, 40 stocks. Another example you can go to is the First Trust Green Energy ETF. This one is like the last one, except it's just focused on U.S. companies, and Elon Musk companies are about an 18% weighting, so very heavy with Elon Musk companies. This one, it's up 16%. And then a third one that's a little more of a wild card is the Global X Lithium ETF.
I can't imagine that's a heavily traded ETF.
It isn't, but it's...
Lithium goes into batteries, of course, right?
That's right. You know, this announcement of the Gigafactory, the world's largest battery factory, this ETF popped on that. It's up 10% this week. The volume's up over 100,000 shares, so it's growing. As you can imagine, it's a very niche ETF. It only tracks about 20 companies, and about the top 10 account for 80% of the whole portfolio. But due to this announcement, and also you've got smartphones and iPhones that are using lithium, this is pretty well positioned for the future. So it's looking like a decent value play, and it's starting to get some momentum as well.
I would imagine, though, that overall that these alternative energy and green energy ETFs, I mean, there must be a lot of volatility there, because you see a lot of volatility in solar stocks, for example. I know TAN is the solar ETF. And so even though you may be trying to ride the Musk wave, there is a little bit of cautionary. I mean, and Tesla itself is reasonably volatile. So maybe a little bit of caution is warranted with some of these, right?
Absolutely. I refer to using niche ETFs as cooking with spices. You know, this is an alpha play. This is to just put on a satellite on the outer layer. You like the story, you throw it on there, you accept the volatility for the idea that you can participate in something like Elon Musk's magic. Because once these companies get bigger, they are going to become less volatile. They're going to return less. And then they're going to be in the big indices like the SPY. And that's when a lot of people will feel that. But if you want to participate in these early growth spurts, you kind of have to go to the niche space, yeah.
All right, let's get to the ticker of the week, and that is M&A, because obviously it's been a very busy time for M&A.
Yeah, I mean, I've read, the most since 2007. This is the Index IQ Merger Arbitrage ETF with the great ticker M&A. This is literally a hedge fund replication ETF. So it tries to act like a hedge fund. It goes long the target companies, then it shorts out 2 global indices in order to isolate the price from the time the announcement's made to the time the deal's done. And by doing that, it doesn't kill it, right? It doesn't outperform the S&P, but it gives you, in this case, 3% return year to date, 9% over the past year, but it does it with less than half the volatility of the S&P. It's a good equity diversifier. In fact, the correlation on this is about the same as Vietnam, so it really has no correlation, and it's designed to mimic a hedge fund. It's taking a complicated strategy and really packaging it for the masses, and it's 76 basis points is the expense ratio. Now that's way cheaper than a hedge fund, which is like 2 and 20 typically. And I did a little research, and the return, that 9% over the past year, is actually about double the average merger arbitrage hedge fund.
Oh, interesting. Yeah. Okay, thanks
so kind of
much.
A poor man's hedge fund ETF there.
Eric Balchunas, nice little good digging on that one.